right now, today, roughly $7 trillion is going to change hands.
Yeah, and not in the stock market either.
Right, not in real estate. It's happening completely invisibly in a market that literally never sleeps.
Yeah.
And, chances are your favorite social media influencer is trying to convince you that you can grab a slice of that $7 trillion pie without ever leaving your couch.
It is, it's really the ultimate modern financial fantasy. You scroll through your algorithmic feed and you see the luxury cars, the glowing charts on a laptop by a pool.
Oh yeah, the classic laptop on the beach setup.
Exactly. And they're pushing this promise that with just a little bit of capital, you can, like, hack the global economy.
And the buzzword they always use is Forex, foreign exchange. Now, if you are listening to this deep dive, you probably already know what an exchange rate is, right? You know that currencies fluctuate.
Sure.
But there is a massive gulf between understanding that, a euro costs a certain amount of dollars and understanding what is actually happening on those laptop screens.
Oh, absolutely. It's a totally different ballgame.
So today, we are stripping away the lifestyle marketing. We're opening up the hood on the biggest financial engine on Earth to figure out the actual mechanics of how this works.
Yeah, and we need to look at why retail traders are suddenly so obsessed with it.
Right, and what happens when everyday people step into an arena that's basically designed for financial titans?
It's a completely necessary shift in perspective, I think, because when you stop looking at the social media hype and start looking at the bare mechanics of foreign exchange trading, you realize you aren't just looking at a way to make a quick buck.
You're looking at the actual central nervous system of global finance.
Exactly. You're looking at the plumbing of the entire world.
Well, let's start right there with the scale of this thing, because it is almost impossible for the human brain to comprehend. $7 trillion a day.
It's a staggering number.
Just to put that in perspective for you, if you look at the major stock exchanges, you're talking about billions of dollars moving daily. Forex makes the stock market look like a neighborhood lemonade stand.
It really does. It is a relentlessly deep pool of capital. And that volume is exactly why the market functions the way it does.
Because it's so big.
Yeah, it's so massive that no single entity, I mean, not even the wealthiest individual on Earth can manipulate it for very long. It just dwarfs everything else. But what's really interesting is looking at who is actually pouring all that money into the pool.
Right, the ecosystem. Because it's a bizarre mix, isn't it? At the top of the food chain, you have governments and central banks. Then you have massive multinational corporations. Below them, you've got major commercial banks and professional institutional traders.
Yeah.
And then at the absolute bottom of the list, sharing the exact same water, is the beginner retail trader, like the person on the couch.
It's basically the only arena in the world where that happens. You have a person with, $500 on a smartphone interacting with the exact same price feeds as a central bank, managing the economic reserves of an entire nation.
Okay, wait, hold on. This is where the whole concept starts to sound completely irrational to me. Well, if governments and major banks are moving billions or trillions of dollars at a time, how does a retail trader not just get instantly crushed? I mean, it feels like stepping onto a basketball court to play one-on-one against a professional all-star team. You are going to get trampled.
Yeah, and that is the logical assumption, but it actually misunderstands how a beginner trader makes money.
Okay, unpack that for me.
Well, they aren't playing against the central banks. They actually require the central banks to exist. The presence of those massive global entities is exactly what creates the environment the retail trader needs.
Why? Because they create the movement.
Exactly. Think about the basic mechanics of supply and demand. Let's say a massive Japanese tech company needs to pay its American suppliers.
Okay.
They hold billions in Japanese yen, right? But the supplier only accepts US dollars.
Right, so they have to convert it.
Exactly. So this corporation enters the Forex market and just dumps billions of yen to buy billions of dollars.
And because they're buying so many dollars all at once, they just eat up all the available supply of dollars at the current price.
Precisely. They create a sudden, massive scarcity of dollars at that specific price point, which forces the price of the dollar to go up relative to the yen.
Oh, wow.
Yeah, these massive trillion-dollar tectonic plates are constantly shifting for boring real-world reasons like payroll, international trade, and national reserves.
And those shifts create massive waves in price.
Right, so the beginner trader isn't trying to outmuscle the corporation. They are trying to observe the ripple that corporation is making in the water and just ride that wave for a few fractions of a cent to make a profit.
I hear that, but let me push back again.
Sure.
If I'm sitting at my kitchen table looking at an app, by the time I see a government or a massive corporation moving billions of dollars on my screen, hasn't the wave already passed?
That's a fair point.
Like, how can a beginner sitting at home possibly react fast enough to catch a wave created by institutional algorithms?
That is the million-dollar question, isn't it? And honestly, it's why most beginners fail. You are absolutely right that by the time you see the giant spike on your chart, the initial move is over.
Right.
The institutions have already executed. But institutional money is so massive that it can't enter the market all at once without causing total chaos. It takes time for those giant orders to get filled. They leave a footprint.
Okay. So you aren't trying to beat the institution to the punch. You are looking for the massive footprints they leave behind, assuming they're going to keep walking in that direction for a little while.
Yes, exactly. You are looking for the momentum that these massive transactions create. Because without the major institutions, the water would be totally still.
Nothing would move.
Right, the price wouldn't move enough to offer any opportunities for profit. The whales create the waves, and the retail traders are trying to be the remoras swimming alongside them.
Which brings us to the actual mechanics of how you catch one of these waves. Because, I mean, you can't just go into the market and say, I think the US dollar is going to do really well today. Let me buy some US dollar.
Nah.
That isn't how foreign exchange works at all.
No, it isn't. The foundational rule of this market is that currencies are traded in pairs, always. You have to measure the value of a currency against something else.
You see this constantly on financial news tickers, right? Like
Yeah.
USD, the euro, and the US dollar.
Yep.
Or GBP USD, the British pound and the US dollar. Or USD JPY, the dollar and the Japanese yen. If you buy the USD pair, you are simultaneously buying euros and selling dollars.
Right.
But that simultaneous action is a massive mental hurdle if you are used to the stock market.
How so? I mean, what's the hang-up?
Well, if I buy a share of a tech company, I'm just buying that share. I'm putting my money on that specific company, hoping they build a better phone or whatever. I want them to succeed.
Right.
I am not simultaneously betting against a shoe company. But Forex doesn't work in isolation. It's a seesaw.
Oh, I like that. It's a perfect visualization, but explain who's sitting on it.
Okay, so it's a seesaw, but the entities sitting on either side aren't kids on a playground. They are entire national economies.
Right.
On one side of the plank, you have the European Union. On the other side, you have the United States. When you log into an app and decide to buy the Eurobars USD pair, you are not actually getting on the seesaw.
Uh-huh.
You're the person standing at the edge of the playground, actively placing a bet that the euro side of the seesaw is going to get heavier, lifting the US dollar side up into the air.
That's a great way to put it. And that price you see flashing on your screen, the actual exchange rate, is just the real-time balance point of that seesaw.
Exactly.
It is telling you exactly how many US dollars it takes to balance out 1 euro at this very millisecond.
Right. And if the exchange rate goes up after you place your bet, meaning the euro just got heavier on our seesaw and it now takes more dollars to balance it out, you are making a profit.
Yep.
But if you're wrong and the US dollar suddenly gains weight because the US economy releases a great jobs report or something, the seesaw tips the other way and you are losing money.
This is the core insight that gets lost in all those flashy YouTube tutorials. When you trade a currency pair, you are trading relative macroeconomic strength.
So it's not just a line on a chart.
No, not at all. You are looking at the economic health, the interest rates, the political stability of the European Union, and weighing it directly against the economic health, the interest rates, and the political stability of the United States.
So if you're listening to this and thinking, well, I'll just follow the trend of the US dollar, you have to remember that you aren't just looking at the US. You have to be right about the US and right about the opposing currency simultaneously.
Exactly.
Which sounds incredibly complex. I mean, analyzing the relative strength of two global economies is the job of entire floors of analysts at Goldman Sachs.
Yeah, people with PhDs.
Right. So why is my teenage nephew suddenly downloading trading apps? Why is this blowing up?
Because the financial industry has systematically removed almost every single barrier to entry. The underlying analysis is incredibly complex, sure, but the act of participating has been made dangerously simple. There are, several specific reasons why Forex has massive, mass appeal right now, and they all center around accessibility.
Well, the first one is capital, right?
Yeah.
You can start with small money. You don't need a massive brokerage account. You don't need a five-figure minimum deposit.
Nope. Yeah.
You
No.
can literally fund an account with $50.
Which completely democratizes access.
Yeah.
In the past, participating in the foreign exchange market was exclusively the domain of the ultra-wealthy or the institutional players. Now, the velvet rope is gone.
And the doors never close. I mean, the stock market has a very defined schedule. The opening bell rings, and at 4 p.m., it's over. But the Forex market is open 24 hours a day, 5 days a week.
Yeah, the weekends are closed, but during the week, it just doesn't stop.
If you want to trade at 3 in the morning on a Tuesday, the market is humming.
And it's humming because the sun is always shining somewhere on the global economy. When the financial centers in New York are wrapping up their day, the banks in Sydney and Tokyo are just firing up.
It's like a relay race.
Exactly. The baton gets passed around the globe, creating a continuous, unbroken chain of liquidity from Monday morning in Australia to Friday evening in New York.
And then there is the ultimate hook, which is the technology. You can do all of this right from your phone.
Yep, sitting on your couch.
You have the app, the market never closes, and because it's a global market, there are many opportunities every single day. The price is always moving. But, and this is a massive warning light, isn't this exact combination of factors a huge psychological trap?
Oh, it is the ultimate trap. And it brings us to a fascinating paradox.
It's that.
The very things that make the Forex market so appealing to beginners, the 245 access, the smartphone apps, the low barrier to entry, are the exact same factors that destroy them.
Okay, explain that. Why is frictionless access the enemy of the amateur trader?
Because friction used to protect people from their own worst impulses. Think about how trading worked just a few decades ago. If you wanted to execute a trade, you had to actually call a physical broker on the telephone. You had to explain your order. Maybe they put you on hold. That entire process took, what, 10 or 15 minutes?
Right, it created a buffer.
Exactly. It gave you a 15-minute buffer to calm down, to rethink a purely emotional decision. If you suffered a loss, you couldn't just instantly double down in a fit of rage.
You have to dial the phone again.
Right. Today, an app removes that buffer completely. It turns massive global market volatility into a slot machine that sits right in your pocket.
Wow.
You can wake up at 3 a.m., roll over, grab your phone in the dark, and instantly expose your money to a $7 trillion market based on a feeling.
And because there are so many opportunities every day, the temptation is ceaseless. It creates a sort of false equivalence in the beginner's mind, doesn't it?
Oh, so?
Well, the app is incredibly easy to download. Transferring $50 is incredibly easy. Pressing the green buy button is incredibly easy. So the brain logically assumes that making money must be easy too.
Oh, absolutely. Which is precisely why anyone stepping into this arena needs a severe reality check. You cannot survive on intuition and easy access.
Right.
You need an entirely different set of tools, both technological and psychological.
Let's break down exactly what those tools are. First, the mechanical stuff.
Yeah.
You can't just connect your checking account to the global market.
Yeah.
You need a broker. They act as the intermediary between your small money and the massive institutional order books.
Yep.
And you need a specialized trading platform. The industry standards are usually apps like MetaTrader 4 or MetaTrader 5.
Yeah, those platforms are where you actually view the charts, do your analysis, and execute the trades. But having a broker and a charting app just means you have a car. It doesn't mean you know how to drive.
Right, and this is where the survival mechanics come in. The absolute bare minimum requirements are basic knowledge, a defined strategy, and risk management.
Risk management is key.
I really want to zero in on that last one because risk management feels like the dividing line between the people making the YouTube videos and the people actually trading for a living.
It is the only line that matters. The beginner trader obsessively focuses on profits. They look at the chart and think, how much money can I make if this goes right?
Always looking at the upside.
Exactly. But the professional trader, the one who actually survives the $7 trillion ocean, looks at the exact same chart and thinks, how much capital will I lose if this goes wrong?
That is a fundamental psychological shift.
It changes everything. Risk management isn't just a buzzword, it is a mathematical discipline. It means knowing exactly where you are going to exit a losing trade before you ever hit the buy button.
Wow. Before you even enter.
Always. It means never risking more than 1 or 2% of your total account on any single wave. Because in a market that moves 24 hours a day, driven by geopolitical events you cannot possibly predict, you are going to be wrong. Frequently.
The influencers show the winning side of the seesaw. But risk management is about having a highly structured plan for the inevitable moments when a central bank drops a piano on the other side of your seesaw.
Right. If you don't have a strategy for survival, you aren't trading. You are just guessing in a casino where the house is run by macroeconomic
Crook's
forces.
terrifying when you think about it.
It is. This is why the warning cannot be overstated. Jumping in without a profound understanding of risk is just financial suicide.
So where does this leave you, the listener? If you've been bombarded by these flashy videos, hopefully, you now have a fundamentally different view of what is actually happening on those screens. We have moved way past the superficial hype.
Yeah, we've looked at the massive scale, $7 trillion changing hands every day, moving the needle on global commerce.
Right.
We've broken down the mechanics of the market, how institutional whales create the waves that retail traders try to ride.
And we dissected the seesaw of currency pairs. The fact that you are never just buying a currency, you're always weighing the relative economic strength of two entirely different nations.
Yep.
And we confronted the brutal reality of the frictionless trap. The fact that downloading MetaTrader 5 to your phone gives you unprecedented access, but without rigorous, disciplined risk management, that access is just a fast track to losing your capital.
Definitely. And, whether you ever decide to fund a brokerage account or not, understanding the mechanics of this market is crucial because it demystifies the invisible forces that shape our world.
How do you mean?
Well, the foreign exchange market is the plumbing of the global economy. Every time you buy an imported laptop or book a flight overseas or read a headline about inflation, you are experiencing the real-world ripples of this exact market.
It is the financial water we are all swimming in.
Exactly.
Which leaves us with one final, deeply sobering thought for this deep dive. Something for you to consider the next time you see someone bragging about their daily profits online. Based on the fundamental mechanics we've just unpacked, foreign exchange is always traded in pairs. You are buying one currency while selling another.
Which means it is a closed system.
Exactly.
Yeah.
The seesaw cannot tip in one direction unless weight is applied to the other. So if a beginner trader is sitting on their couch, smiling because he just hit buy on the USD pair and made a $50 profit, well, that money didn't just appear out of thin air.
Yep.
Because it is a system of pairs, every transaction requires a buyer and a seller. If you made a profit on that seesaw, someone, somewhere else in the world, had to be on the losing side of that exact same trade.
Someone else's account balance had to go down for yours to go up.
So if you do decide to enter this arena and you pull up the app and you get ready to risk your money, when you hit that button on your phone, who do you think you're really betting against? Is it an algorithm? Is it a central bank? Or is it just another beginner sitting on their couch hoping for the exact same wave?